Corporate Formalities, Helping Clients Tame the Beast, from the Tax Review Series at Tax Materials Incorporated. To get started, you'll notice a number down in the bottom right of the screen capture. This number corresponds to the page number in the study guide if you are following along from the study guide that was available for download from the website. This course is separated into 3 learning objectives. Successful completion of this course will enable the participant to weigh the benefits of operating a business as a corporation against the need to adhere to corporate formalities necessary to maintain the integrity of the corporate structure, explain to shareholders the necessity of following strict formalities in dealing with their corporation to preserve the integrity of the corporate veil, and assist shareholders in complying with federal tax law to avoid reclassification of transactions by the IRS. Learning Objective A. Weighing the benefits of operating a business as a corporation against the need to adhere to corporate formalities necessary to maintain the integrity of the corporate structure. This can be a challenge, especially for single shareholder corporations, to impress upon them the importance of operating as a corporation and observing corporate formalities so that their corporation stays intact and serves a purpose that it was created for. Let's talk about a few of the glossary terms before we get started. It will be helpful to know the meaning of these terms as we go through the course. Capitalization. This is the level of funding for a corporation or other business entity. Inadequate capitalization can indicate the lack of viability of a corporation. And we'll see going forward that courts will sometimes look at the level to which a business or a corporation is capitalized to determine whether that corporation actually exists or whether the business was operating as a corporation. Piercing the corporate veil. In some cases, a court will pierce the corporate veil, which disregards the liability shield, holding shareholders personally liable for monetary damages. One of the primary reasons why people form corporations is to protect themselves from personal liability for claims against the business. Courts can pierce the corporate veil if there is a claim and go straight through to the shareholder, and this can be especially problematic for single shareholder corporations or closely held corporations. Intermingling is failure to separate financial transactions between a shareholder and a corporation or other business entity. Intermingling can occur when a shareholder, for example, pays corporate expenses out of pocket or uses the corporate checking account to pay personal expenses. And this is usually done with good intentions that they will fix the books later on, but this can be an indication that a business was not operating as a corporation and can be problematic for a single shareholder or a closely held corporation. Constructive dividends are payments from a corporation to a shareholder treated as non-taxable that may be recharacterized by the IRS as taxable dividends. Constructive dividends, now that might sound nice, but that is not nice. They were payments from a corporation that were intended to be non-taxable, such as loan repayments or purchase of stock from the shareholder, items such as this that are recharacterized by the IRS and end up being treated as taxable dividend payments. So essentially, constructive dividends are recharacterized by the IRS as taxable. Corporate characteristics. A corporation can be described as an artificial person. One of the primary reasons why many people incorporate is to limit their personal liability for losses that go through the business. A corporation is formed by each individual state and has independent legal status. Again, much as a person can earn income, own property, this type of thing, a corporation is a separate legal entity that can also own property, earn income. And adhering to corporate formalities is especially important to maintain the integrity of the corporation, because if the corporation is found not to be viable, then the corporate veil can be pierced and that liability shield goes away. Limited liability companies are created by each state. They were originally set up to be taxed as partnerships, but still have the limited liability of a corporation. Now, limited liability companies can elect to be treated as corporations for federal tax purposes. For federal tax purposes, a normal business corporation is generally taxed either as a C corporation or an S corporation. C corporation pays tax, and the after-tax income from the corporation is distributed to shareholders as taxable dividends. One of the reasons that people will form C corporations is there can be advantages of non-taxable fringe benefits coming from the C corporation to a shareholder. In an S corporation, that income will flow through, get my spelling right here, flow through to the shareholder. The S corporation itself does not pay income tax, although it can pay payroll taxes, penalties, etc. But the S corporation itself is not subject to income tax. Now, fringe benefits for an S corporation are treated much the same as for a sole proprietor. There are not as many advantages for fringe benefits through an S corporation as a C corporation. But again, the flow-through aspect of an S corporation, avoiding the double taxation of a C corporation, can make it an attractive corporation for a small business. Forming a corporation. A corporation is creation of each individual state. So the steps to forming a corporation include filing articles of incorporation with the Secretary of State, then obtain a federal EIN number, an employer identification number, hold a board of directors meeting. This can be particularly challenging to explain to a single shareholder corporation that they need to hold a meeting with themselves, but they do in order to adhere to corporate formalities. They need to approve corporate officers and directors, need to approve corporate bylaws. They need to capitalize the corporation. Again, capitalization is an issue that courts often look at to find if a corporation is viable and whether that corporate veil still exists. Issue stock to shareholders evidenced by stock certificates, have a separate corporate banking account, completely separate and operated completely separate from the personal banking account of the shareholders, and to record all the important activities of the corporation in the corporation's minute book. The corporate mentality. It can be a real challenge for a tax preparer to explain, to impress upon a client the need to adhere to corporate formalities, what those corporate formalities mean, what they're for, why they're important, why that client has to hold board meetings with themselves. They think that's kind of dumb. In a lot of cases, what happens is you've got a tax preparer. Let's say this is Chuck. Chuck's a tax preparer. Excuse my bad art here. Chuck's a tax preparer sitting behind his desk. It's tax season. Chuck's a happy tax preparer. Chuck's client comes in for an appointment to get a tax return done. And lo and behold, in the client's papers, as he's going through what he thought was just the run-of-the-mill sole proprietorship Schedule C, he discovers articles of incorporation. And he asks the client, did you incorporate last year? And the client very proudly says, yes, I did. And just knowing that Chuck will be very impressed that he incorporated all by himself. And now he is operating as a corporation just like the big guys. when the client doesn't realize that what he did was he created a next door neighbor. The client doesn't realize that he created an artificial person. We're going to call this person Art. This person can own income. This person can own property. This person can buy and sell property. This person can incur liability. This person can sue and be sued. Art is an artificial person, and actually some people, depending on what kind of a mess is created before the tax preparer can get involved with it, some people have been known to refer to this artificial person as a Frank, as in creating Frankenstein. So Chuck immediately has to determine whether the corporate formalities were adhered to, and whether, number one, the corporation really exists, and number two, was the business operating as a corporation. So Chuck asks his client, did you capitalize the corporation? And going back to the issues as far as setting up a corporation, was there stock issued? Did you appoint corporate officers and directors? Did you intermingle funds? Did you operate this as a separate entity where you are an employee of the corporation, or did you just expect to check that magic box on your tax return that says, yes, I'm a corporation and everything's supposed to work out? Don't go to sleep. We'll have self-quizzes popping up. Self-quiz number 1, this is a true-false question. A corporation is not considered to come into existence until the appropriate election forms are filed with the IRS. We'll give you a few moments to think about that one. Time's up. If you answered true, that is incorrect. Although an election must be filed for a corporation to be treated as an S corporation under federal law, or for an LLC to elect to be treated as a corporation under federal law, corporations are formed under the laws of each individual state. A corporation is a state creation. If you answered false, that is correct. Corporations are formed under the laws of each individual state, and there are rules for federal tax treatment under the Internal Revenue Code.